Your money's future could hinge on one simple choice: RRSP or TFSA. The right pick can grow tax-free money and trim your taxes today. I won't pretend it's perfect for everyone. We'll break it into a practical plan you can apply this year. First, what do these accounts do? RRSP gives a tax break now. TFSA gives tax-free growth and flexible withdrawals. That difference matters because timing is money. Start by listing your goals for the next 5 to 10 years. Do you want a home, a new car, travel, or a cushion for retirement? This matters because TFSA funds can be used for anything tax-free, while RRSP funds are taxed when you withdraw. Strategy number 2. Fill TFSA first. Put money there up to the annual limit and invest in a simple, low-cost mix like broad index funds or a balanced ETF. The reason is clear. You can take money out when you need it, without taxes, and you already paid taxes on what you contributed. That flexibility is powerful for emergencies or big milestones. Now the third move, bring in RRSP when it makes sense for your tax picture. If you're earning a decent income now and expect your tax rate to drop in retirement, RRSP contributions can save you money over time. The tax deduction lowers your current bill, and the investments grow tax-deferred until you withdraw. If you anticipate being in a similar or lower bracket later, RRSP can be a smart boost, but don't treat them as separate closets. Use both, guided by real numbers. If your employer offers a group RRSP or any matching contribution, take it. Free money is rare, and it compounds. If you're saving for education or a large future purchase, consider using part of your TFSA for flexibility and the rest in RRSP to maximize tax efficiency. There are a couple of features worth noting. If you ever want to buy a home, the RRSP Home Buyers Plan lets you borrow from yourself to fund the purchase, with repayments over time. TFSA money can be used for a home too, but without a tax break. If you're unsure, think of TFSA as your everyday growth account and RRSP as your retirement growth engine. Next, set up a simple, repeatable system. Automate contributions to both accounts through the year. A fixed monthly amount to TFSA and another to RRSP keeps you consistent, avoiding the fear of missing a big year. Review the split once a year. Did you get a raise, a bonus, or a career change? Tweak the balance so you're leveraging the best tax outcomes without overcomplicating things. A quick way to think about it is this: TFSA for the near-term and flexible needs, RRSP for the long-term and tax relief if your current rate is high. For a younger person starting out, TFSA first is often the simplest. If you move into a higher income bracket, you may shift more into RRSP to capture the tax deduction now and let the growth run tax-deferred. Here are 2 practical scenarios. You're early in your career, earning modestly, with plans for big goals in 5 to 7 years. You'd lean heavily on TFSA for building wealth without worrying about taxes on withdrawals later. You still keep a small RRSP cushion for a tax break if your income rises or if you expect a drop in tax rate in retirement. Fast forward to mid-career with a steady raise and a retirement date on the horizon. You start balancing contributions, push more into RRSP to save on current taxes, and use TFSA for liquidity and flexibility as you approach retirement. You're building a 2-track engine, tax savings now and tax-free withdrawals later. In short, know your plan, not just your wallet. Use TFSA for growth and flexibility, especially if you value access to your money. Use RRSP when you expect a tax break today and a lower rate tomorrow, or when a group plan and future retirement funding align. If you're picking one box today, think about your current and future tax map, your goals, and your need for flexibility. Then set up automatic contributions and commit to a yearly check-in. The goal isn't perfection. It's steady progress with a plan you actually follow. If this helped, hit like, subscribe for more clear, practical money guides, and tell me in the comments which approach you're leaning toward and why.